Netflix sharply higher in overtime right now. That Q4 earnings call just getting underway. We are monitoring for any headlines. We're going to bring them to you. Joining us now is Jamie Lumley, though, a senior analyst from Third Bridge. Jamie, it's great to have you on. Obviously, we saw this huge subscriber beat, but we also saw for a Q4 operating income and operating margin, both significantly ahead of estimates, and free cash flow numbers for the current year, certainly looking pretty robust as well. Give me your takeaway from this report. How do you think about it where Netflix is concerned, as the stock does move up 7% right now?
So looking through those two pieces you mentioned, let's first think about subscriber growth, which is where I think most people look when Netflix is reporting earnings. That 13 million is certainly remarkable. It's a step above where it was last quarter and what was a very strong Q3. And it's also noticeably in front of where it was in Q4 2022, which was a very strong quarter for Netflix as well. What this indicates is really the ongoing strength in the scaling of the ad tier business, particularly scaling up at the end of last year, and also the momentum the company's building in its crackdown on password sharing. Implementing paid sharing has coincided with reigniting growth in the US and Canada, as well as also seeing really strong growth numbers in other main regions for Netflix, which all saw remarkable year-on-year improvements in Europe, Asia Pacific, and Latin America. To the net income piece, we're definitely looking at an interesting year as Netflix is coming out of the Hollywood strikes, definitely seeing some impact to delayed spending on content costs, but definitely from a Netflix standpoint, they're appreciating the short-term windfall. The big question, of course, is what sort of effects will that have in 2024 as content spend resumes normal levels?
Do you think Netflix is going to have to spend as much on content, especially in a world where it is generating free cash flow, it is profitable, and you have all of these legacy media players who are now trying to play catch up and potentially looking to merge to do so?
So at Third Bridge, we've been hearing a few things. In terms of overall content spend, our experts expect that Netflix will probably maintain its current levels, around 17 billion or so on content spend per year, and then in a few years might start to inch that up in a single-digit percentage range. What's more interesting, of course, is looking at where that spend is going. Just this morning, Netflix announced their deal with the WWE with 10 years of programming for WWE Raw. They're definitely changing the way they engage consumers, which is important for the company because while they have industry-leading subscriber base today, ongoing engagement is the name of the game, and people will only stick around with a streaming service if there's new content, new ways for them to engage, and stay happy with that service.
How do you expect, Jamie, for Live to impact the margin outlook for Netflix as they do more of these deals, whether they're in sports or entertainment or sports entertainment like we saw from WWE? Is that potentially cheaper for them, or given all the competition for some sorts of live programming, does that end up being more expensive?
It's a great question, and in short, it depends. If we think about what the WWE deal brings, one thing which is remarkable is the fact that this is hours of entertainment, weekly shows being brought to Netflix. They're definitely getting a lot of programming in this deal, although, of course, it is at a fairly high cost. When we think about how Netflix has been approaching live programming, they haven't dove into traditional live sports, which are incredibly expensive. And for that, while they might get high levels of engagement, if we just think about the value of streaming rights, what Amazon did with Thursday Night Football, for example, or what Apple's doing with the MLB and MLS, these are huge deals, and they can definitely make the ROI on that sort of content investment a little bit more challenging. So from Netflix's standpoint, investing in some of this can be cheaper depending on the type of live programming they get. That can definitely have some savings versus premium prestige scripted dramas. But of course, it depends on where they necessarily want to invest.
Okay. Stocks now at session highs and post-market trading as that conference call kicks off. Jamie Lumley, thanks for sharing your insights.